Good morning. I'm Mehdi Sunderji and welcome to OETV. We're here live with Jeffrey Hughes, founder at Alpha Insights. So as we're here, the market's open. The market seems to be down about 65 basis points, kind of following on from yesterday's weakness. Jeff, you published your big monthly piece, a review and outlook report on Sunday evening. Great read for positioning your portfolio into year end. I'd like to advise our viewers to check it out in depth. But before we get into the weeds with it and some of the content, would you mind starting us off as usual with your top down?
Sure. Well, first of all, thanks a lot for having me on the show today, Mehdi. About an hour later than we usually do it, so I've had a lot of time to prepare. At the end of the day, I think, yeah, at the end of the day, I think investors need to take into consideration what has happened. Everything is initial conditions dependent, right? And we've had, a 15, 16% rally in equities, a little bit higher if you're narrowing it down to the Dow Jones Industrials. And, rates have pulled all the way back to nearly 3.5%. And so, these are levels that I think are critical, right? And in our opinion, things have kind of reached their limits and are ready to reverse. Now, could we get a little bit more to the upside? There's always the possibility. We've got a couple of scenarios that we've traced out where, maybe the S&P can, squeak out another 100 points to the upside. But at the end of the day, we think we're very, very close to the turning point if we haven't already hit it. The recent high was achieved on December 1st. If that high holds, then we believe the market is at the precipice of a third wave decline, and a break below 3906 on the S&P 500 would confirm that we are, at the early onset of that. And so that's kind of what we're waiting for with respect to the market. I think one of the things that will have people surprised is the spike in volatility that will, attend that decline. Volatility's pulled back into the high teens again. This has kind of been the area where stocks have peaked as the VIX has hit that level. And so, we think that the two will kind of reverse together and rates will likely move higher as well. And we're also looking for the dollar to move higher.
All right, thank you for that recap. Jeff, you start your monthly piece off with a chart again highlighting that the a financial crisis threat is kind of high risk right now. Would you mind talking us through this?
Sure. This is a model that we created after the great financial crisis to try and help us anticipate that change again if in fact it were to ever occur. And what we simply did is we took a basket of highly interest rate sensitive securities and paired it with a basket of rate proxies, right? And so it's basically a ratio of the two. And as the model line, the black line, breaks to the upside, that suggests that things are hunky-dory, right? When it breaks to the downside, that suggests that there is a tightening of financial conditions, the liquidity is running dry, and that tends to attend a financial crisis. So, right now the risk is high, and it has been high since about March 31st when the model broke the signal line, and it has not recovered above the neutral line yet. And so we continue to hold below that high risk signal line. And at this point, we continue to suggest that investors would do themselves well by maintaining a tail risk hedge on their portfolio. We're suggesting about 10% allocation to the tail risk hedge.
And let's say you touched on some of the technicals earlier as well in your top-down view. Would you mind running us through your preferred Elliott wave count just to recap on some of the levels that you've been discussing over the last several weeks?
Yeah, on the left-hand side, we're kind of looking at our cycle degree view, which suggests that the entire 13-year advance off the 2009 lows is in fact cycle wave 5, likely topping super cycle wave 3. And if that's the case, then we're in the very, very early innings of a corrective waveform of super cycle degree, which could carry the markets, significantly lower. We think at very minimum 2250 on the S&P 500, but more likely something down into the sub 1000 level eventually. That could be years in the making. We're thinking 2025 at the earliest, but it could take a decade depending on what type of corrective waveform ultimately is traced out. And we won't know that until we get more data, then we can begin to anticipate that change. But at this point, we're really focused on primary degree view, which is on the right-hand side. And this is really just taking a look at the final move up, primary wave 5 of cycle wave 5 off the March 2020 lows, and the subsequent decline off the January 22 highs into present. And so, the count that we're most confident in is the 5-wave decline off the January high into the June low as representing primary wave 1 down, and the counter trend advance, the 3-wave counter trend advance into the August highs representing primary wave 2 up of a 5-wave motive wave decline, which means that we are in the early innings of primary wave 3 down. We count the October low as intermediate wave 1, and the December 1st high so far is intermediate wave 2. This count will remain in effect unless the S&P 500 exceeds 43.25. We do not anticipate that occurring. So, our view is that, intermediate wave 2 either peaked or is very, very close to peaking. And the next big move will be to the downside, which should carry the market down to at least 2750, perhaps as low as 2400 in primary wave 3 down before the next counter trend advance of any substance, halts or arrests that decline.
Got it. And 43.25 is that magic number to change things on the picture.
We call that the make or break number.
Got it. Make or break magic. I like it. So Jeff, this obviously you're a big monthly piece. You cover an awful lot of topics, and you break down things like global asset class leadership, US factor leadership, as well as US style box leadership. I'd like to touch on your US style leadership. US style box leadership here. We've discussed some of this over the last several months, but do you see growth gaining traction versus value, or are we still going to be riding the value train for short term, long term, midterm?
Yeah, I think during this bear market rally, we have seen growth reassert itself to some extent, but not as much as we would have hoped, in order to suggest that something's changing here, right? And so value continues to hold the lead. We've been particularly impressed with mid caps. Mid caps are the only market cap segment of the US markets that we have not downgraded to bearish. And as we saw last month, mid cap value led up 7% during the month of November. Growth a little more tepid, only up 4.7%. It was actually the worst performer of the entire Russell style box breakdown. Pretty much growth and value on the small cap and large cap side were essentially paired off equally. So the real leadership came from mid cap value, and we continue to focus on value stocks. We continue to focus on mid caps within the S&P 1500 as kind of being the area of outperformance. So we'll continue to remain neutral on mid caps until we see, deterioration such that it would indicate, a more bearish profile. At this point, large caps, we continue to hold our bearish view. Small caps, we continue to hold a bearish view.
What about that middle part of the market? How about market breadth? It looks like things are looking a bit more positive here as well.
It has improved. There's no question about it. If we just look at NYSE stocks trading above their 200-day moving average, we got to around 50%. That's the highest level we've seen in, really the last year, more or less. However, on the NASDAQ, it's not quite, such a exciting story. It's closer to around 30%. And if we aggregate the 5,600 some odd stocks that make up the NYSE and the NASDAQ composites, only about 40% of all US stocks are trading above their 200-day moving averages. And what was probably more notable is, we have seen some improvement in the number of new highs on a monthly basis. However, the number of new lows continued to exceed the number of new highs in the month of November on an aggregate basis. And so we're not seeing anything that really suggests to us that, you know, the advance off the October 13th low is anything more than a counter trend advance.
Jeff, this chart is actually very interesting on cumulative net new highs. How is the trend looking on this side?
Well, you know, we've broken the longer term advance, right, in both NYSE and NASDAQ composite cumulative net new highs. And so in addition, we've broken some key chart support levels with the NYSE on the top panel. We've broken that level, but you know, the trend does appear to be flattening out on cumulative net new highs in NYSE. And that might have something to do with the fact that there's a lot of bond proxies and, you know, high yielding securities in the NYSE. And obviously, bonds have done very, very well over the course of the last month. And so that may have propped things up a little bit. If we look at the NASDAQ made a new post 2013 low. And so NASDAQ continues to plunge, right, in terms of cumulative net new highs. And, you know, we're particularly concerned about that area of the market because that is the quote unquote growth sector of the market, right, the up and comers. And so it doesn't appear to have seen the sort of stabilization that we've seen in NYSE cumulative net new highs. So overall, I would say that the data continues to be, you know, a net negative for the market.
Let's talk volatility and, you know, talk us through your title. I love this title.
Yeah. So coiling, boiling, soiling. You know, the question here is, are we going to get a volatility spike? And we didn't show the shorter term chart in this particular deck, but we've been showing it for the past several weeks. And we've been, you know, alluding to the idea that volatility's got down to a point where, you know, historically it's preceded a volatility spike. A couple of things have caught our attention. Number one, it's about as oversold as it's been in the past 3 years. In fact, more oversold than it's been at any point in the last 3 years. In addition, we've seen a positive momentum divergence in our short-term momentum model with respect to the VIX. And so that typically occurs before a trend change. And since the VIX has pulled back into the 20% level, which has kind of been that turning point that's marked the lows for the VIX and the highs for the S&P, we think it's a good point to be on the lookout for a volatility spike or a reversal. We think if we do get that reversal, the first indication will be that the VIX will push back above 24%. 24% has been the level that we've identified as kind of being the boiling point over the last 2 to 3 years. The next check mark that we need to check, or next box we need to check off would be the 21-day moving average. Once the VIX has gotten above its 21-day moving average, it's typically indicated that the trend has turned. And so once those two boxes are checked, I think we'll have more confidence in this. But I think it's a pretty good bet that we're going to see the VIX push up and challenge that short-term downtrend line that's been in place. And if it exceeds the 40% level, then I think the soiling point will start to be germane to those who are long equities.
Coiling, boiling, and soiling. That's going to stick in the head for a while, that one. Let's have a look at any major indications from the put-call ratio that you're seeing.
You know, it's almost complacent. We've seen a big reversal. In fact, we ended the month on November 30th right up at kind of the 1.2 level. This is the total put-call data off the CBOE, which is the largest options exchange. And so we're looking at the ratio of total puts to total calls here. I think this data series has become less and less relevant, mainly because, the amount of short-term options that are being traded has a big influence on it. But, I did want to point out the fact that we went from 1.2 down to, really 0.9, right? And so below 0.9. And so My thinking at this point is that, the market's pretty complacent about risk. There doesn't appear to be any fear in the market. There's all sorts of, anecdotal evidence of bearish surveys and things of this nature, but the actions among traders do not suggest that they're bearish. It suggests that they're actually afraid of missing the rally. And so, I think that this is, more a sign of complacency than anything else.
Got it. Margin debt. We look at margin debt every month. It looks like it's declining yet again.
Well, it did pull back from about 665 or so down to about 649. So, and again, margin debt is reported 30 days in arrears. So we're actually only seeing the data for October. And the deleveraging is probably more consistent with seeing that October low, right? We actually saw the rate of change hold flat at minus 30%. And so, my research suggests that that rate of change level needs to get down to minus 40 to minus 50% in order to signal a liquidation. And we're just not there yet. And so I think, one of the important factors for investors to recognize is that the level of margin debt in absolute terms today exceeds the peak of 2018, the peak of 2007, and the peak of 2000. So we are very heavily leveraged right now. And even though it's come down from its all-time high and is down, 30% off that all-time high, it still shouldn't be dismissed as having liquidated, the excesses in the market. I would suggest that at the peak, which I believe was October of last year, 2021, we were at about 935 billion. Maybe it was August of last year, actually. And that was excessively leveraged. And so the pullback leveraged, should not be dismissed as being, people have liquidated their portfolios. There's a lot of leverage in the system.
And, let's roll on to hot topic number 2 in the market right now. Are you seeing things ease on the underlying inflation dashboard?
Not by much. Certain measures like the core PCE was just reported last Thursday, I believe, and that came in just slightly better than expected. It came in at 5%. The PCE itself, including food and energy, was still 6%. But, the Federal Reserve Board has 9 different banks, each calculating their own sort of version of core inflation. And if we aggregate all of these calculations, we come up with an aggregate level of 420 basis points above target. In other words, if target's 2%, the average measure of core inflation is still above 6% at 6.2. And, a number of Fed governors, most recently Williams, who's probably the most important other than Powell himself, because he's the head of the New York Fed, he made the comment that he won't be satisfied until the Fed funds rate, the benchmark lending rate, is above the inflation rate. And I think he's alluding to kind of this aggregated core inflation of 6.2% that the Federal Reserve's 9 different banks have come up with these calculations. I don't think that he's specifically anchored to the core PCE. And in fact, I think Powell has been more concerned with the headline CPI. So assuming headline CPI can come down below 7% over the next 3 to 6 months, which, base effects themselves would suggest that we're on target to achieve that. I would like to see this aggregation of core inflation drop by 100 basis points as well. And if we can see that occur, then I think we might be closer to out of the woods temporarily. But I think the real risk longer term is that the efforts to quell inflation ultimately result in deflation, which is a much more difficult trend to arrest than inflation. I mean, the Fed, frankly, the only real lever the Fed doesn't have control of is oil prices, and the administration is doing their damnedest to impact oil prices by draining the SPRs, et cetera. And so, we've seen aggregate demand, at least expectations for aggregate demand, be reined in with China's zero COVID policy, with the SPR, supply drain, flooding the market. And so we've kept prices on oil pretty much at bay. The problem is, the Fed could just raise interest rates aggressively and kill inflation. They've chosen not to. They're trying to engineer a soft landing. They've never done that before in the history of the Fed since 1913. So, I don't know why they should be expected to achieve that now. I certainly don't expect them to. I think the real risk is they're going to run the economy into a pretty deep recession, and that may result in deflation, certainly disinflation.
Got it. And obviously, that's the hot topic of the moment, the Fed talk. Just rolling on from that, do you feel that we're going to see 50 bips in December and then 225s in February and March?
Yeah, that's where the street's at right now. And certainly the Fed themselves have all but, signed a document stating that. I think it's a very high probability that we're going to see 50 basis points, not 75. And, the Fed funds futures curve is pricing that in to the extent of around 78% probability. Probabilities in themselves have shifted such that the terminal rate now looks like it's going to be 4 3/4 to 5. I know some Fed officials have been suggesting 5 to 5 1/4. So, there's certainly a lot of jawboning out there to push the street a little bit further out. Right now, at least as of last Friday, it's closed. That's the data point that we used when we published this document. The street was pretty much hovering around that 4 3/4 to 5%. I'll be surprised if they stop below 5%. I think 5 1/4 would be the minimum. I think it's even possible they can go higher than that if we get, a bump in the road, and that's likely. These things don't move linearly. There are issues out there. There's a lot of unpredictable events that could occur, particularly with the war in Ukraine, and what the cap on Russian oil and those things. COVID could continue to spin out of control in China. All these things could have an impact, and so I would just be a little leery about writing home to mom that all things are well.
I hear that, and nothing ever goes in a straight line, that's for sure. We should have learned that by all these years in the markets. Let's talk real GDP. Are you seeing like the slowdown starting to feed through on the data here?
Well, okay, there's a couple of things. First of all, this is a chart indicating the Atlanta Fed's GDP nowcast, right? And so, there's been a pretty exciting shift, right, in real GDP results. The first half saw negative real GDP in the first and second quarter to the tune of minus 1.6 and minus 0.6 respectively. Third quarter revised GDP has now come in at up 2.9 in real terms. So that's kind of canceling out and really putting us on par to produce a 2022 actual real output number of about plus 1%, give or take, on real GDP, based on where this nowcast is pointing right now, and I think it's at around 2.8%, if I'm not mistaken, for the fourth quarter. Now, the thing that's really caught my attention is if we take a look at really the change in growth from 2021 to 2022, right, where the Fed has raised interest rates multiple times. We're going to see, a terminal rate mid-year, probably over 5%, as we just discussed. None of that really was affecting GDP growth in the first half. It takes 6 to 9 months, maybe in some people's opinion, 6 to 12 months for these rate hikes to really, move their way through the economy. And that just hasn't happened. But look at the fall off in growth from 5.6% in 2021 to probably around 1% in 2022. If we get the same sort of rate of change, or about a 460 basis point decline going into 2023, you're going to have a really serious recession on your hands. So, I think in all likelihood, we're going to see real GDP growth continue to wane and decline into next year. And so, the outlook should be cautious if we're looking at real GDP as kind of our benchmark. Nominal GDP is still quite positive, but that's just a function of inflation. If the Fed's successful in quelling inflation, I mean, that's going to affect nominal GDP. It's been a lot of the story, right?
Jeff, you've mentioned recession a few times, and you've been consistent on the fact, we're either within a recession or a rolling recession, or we're headed for a deep recession. Let's have a look at the yield curve. Is this still signaling much of the same?
Well, if we look back over the last 5 recessions, the last 40 years, an inverted yield curve has been something that has preceded, it's been the warning signal that's preceded every recession in that period, right? Especially looking at the 10-2s yield curve spread, which is the lower panel. We are now looking at a spread of, down some 80 basis points, at least as of last week. And that's the deepest inversion since 1981. Okay, so deepest inversion in 40 years. And that was a humdinger of a recession, if I recall correctly. So, my inclination is to be cautious about 2023 as being a year that we could see a relatively deep recession. There's no question in my mind that credit sensitive sectors of the economy, mortgage lending, real estate brokerage, home building, they're already in a recession. There's no question about that, okay? But the entire economy isn't in a recession yet. So we've seen these kind of rolling recessions. I think some areas of manufacturing are continuing to see kind of a resurgence, particularly, heavy industry and truck building and things of that nature. We're starting to see a lot of industrials, experience big new order flow, and it's showing up in their stock prices. And that could be something that kind of, stands out and keeps the bulls, hopeful for 2023 for some time. But I think we need to focus more on the leading indicators, not the lagging indicators. And, the credit sensitive sectors are telling you, look out below.
So you've painted quite the picture for us. How do we position ourselves going into the end of the year and beyond? You obviously break down a lot of asset classes and sectors and such. Let's talk sectors. How would you position yourself going into the end of the year?
Well, I like the defensive sectors myself, traditional utilities, staples, healthcare. Those are the overweights that we've been focused on for some time. We continue to feel like energy, we're still hopeful that energy can hold up there. The longer term relative strength profile of energy remains strong. It's standout, but it was the weakest performing sector in the month of November. So there's that, it has lost a little bit of its luster. That being said, I believe that we are supply constrained on the energy front. And I'm not a fundamental oil analyst, but I have listened to some and read quite a bit on the subject. And it appears to me that we are fundamentally supply constrained in the US. Okay. So, unless we're going to dramatically incent producers to produce, and I know that can be done and that could solve the problem quickly, I think energy stocks are going to continue to benefit from, sustained high oil prices. Now, the price of crude is that, $64,000 question. Is it going to break below 20 or 75? And if it does, then what? We could talk about that, but let's focus on the sectors. The sectors I don't like include those that have been the worst performers thus far. Communication services continue to look like death. Discretionary continue to look like death, despite having an enormous rally in the market in November. Discretionary was the second worst performing sector, up only 1.5%. Technology looks like death. I would remain underweight those 3 sectors. And frankly, if I'm a hedge fund, I'd be short those sectors against utilities, staples, healthcare, and probably energy as well.
Understood. And let's have a look at some of your foreign markets. Are there any opportunities that stand out to you here?
Not much has changed in our view here. Obviously, they've been benefiting dramatically from the decline in the dollar off of its recent peaks. China and South Korea, Germany, Netherlands, Taiwan, rather, those five countries had been the worst performers year to date, basically, and they all had a massive rally this past month with the dollar declining. Those that were leading the commodity-centric economies, Brazil, Canada, Australia, they didn't fare quite as well. UK had a pretty good quarter or good month. India had an okay month. At the end of the day, we continue to like those five sectors on a longer term basis based on their long-term relative strength profile. We think that is going to sustain, right? And we think the other five that I mentioned previously will continue to be underperformers. So that's kind of where we're positioned. We did upgrade a few countries like Italy, France, and I think Spain from bearish to neutral. And they're just market weights. We're not betting on those names, but their charts don't look as egregiously bearish as they did previously. Their rallies have brought them kind of back into the neutral zone. And so, we're willing to just stand aside and not have a vested interest in those names.
And Jeff, thank you. Well, thank you for that. But you also break down some macro assets in your monthly piece. And there's a couple that stand out that I'd really like to get your thoughts on. You mentioned it earlier, crude oil. How's your picture looking for crude oil?
Well, I think crude oil is kind of, dancing on the razor's edge. I think if it takes out 75, then we could get a sharp drop to say 68, and if it breaks 68, then I think we could go to, maybe 60. But I don't think that's going to happen. Like I said, I think we're supply constrained, and certainly here in the US. And so we're talking about WTI. We're the biggest consumer of WTI. The SPR drain is rolling off. And so I think that's going to have a big issue. It'll have a big impact on the supply demand equation. And that should stabilize crude oil prices here in the mid 70s, low 80s. And I think that's a level that I think we can live with under $80. But, the energy companies can make a lot of money at $75 to $80 a barrel oil. And so that's one of the reasons I wouldn't count them out just yet. Profits continue to expand. It's the only sector that's seeing positive earnings revisions. So there's that, right?
That's there for sure. And another one is the US dollar everyone's been talking about.
Our work suggests that the dollar remains in a bull market. I know that we've had a severe correction here, but if we just count this thing off the lows, looking back, say a decade ago, we count a five-wave pattern that appears incomplete. We've got primary wave 1, 2, 3, 4, and then this breakout that we saw here, kind of right where the dollar's trading today, earlier in the year, carried up to around 115, which was our initial target, and we've pulled all the way back to kind of challenge that what was resistance and is now support level, which we've marked as kind of intermediate wave 4. I think if we can hold that level, and it's not necessary that we hold that level for this count to be valid, but if we can hold that level, it's going to add a lot of confidence to my near-term view. And the near-term view is that the dollar's probably bottoming here and ready to reverse higher. Our ultimate upside target is 120 on the dollar. And we're going to stick with that target for now. But I am bullish on the dollar longer term.
Got it. That's quite the move. So let's roll into making some money, Jeff. How do we, let's pick some stocks here. What do we like?
Yeah. On the long side, there's a materials company that stands out, and that's Air Products and Chemicals. APD is the symbol. The stock went out around 311 yesterday. The breakout above 310 resolves a multi-year base pattern that really, it's not a classic pattern, but, it's a definite base. And, the stock is really exhibiting very strong relative strength and very strong momentum. And as a result, we think that there's a good shot that this breakout continues to carry forward. We count a measured upside target to around $400. That's up 28%. Now, if we're wrong, the stock shouldn't pull back below, if we're right, I should say, the stock shouldn't pull back below 291. So that's where we're going to set our stop loss, and that gives us a nice 4-to-1 positive risk view on the stock.
Like it. And what do we not like?
Well, Datadog looks to be quite bearish here. The stock broke its longer-term uptrend earlier this year. It has what I would define as a classic patterned top formation of the head and shoulders variety, and appears to have just resolved below a neckline chart support at around $70. That break below 70 gives us an initial count to around $40, which if it achieves that level would be a 42% upside for short sellers. We think if we're right about this, the stock probably shouldn't be trading anywhere near $84. So that's where we're going to set our stop loss. And, I think from that, we can discern that, weak momentum, weak relative strength, and breakdown of a classic pattern top formation. I think there's a high probability we're going to see our target hit this year. So, we want to be short Datadog and long Air Products.
Jeff, you missed the opportunity to use the wise words of our hero, Gordon Gekko. This looks like a dog with fleas. Jeff, as always, I want to thank you for sharing your thoughts from Alpha Insights. It's always an education.
Pleasure to be here.
Thank you for watching, and good luck investing.